Corporate finance practice problem using OneNote. Impact of bond rating change on bond price. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the 1618 Impact of Bond Rating Change on Bond Price tab. Also note that if using OneNote, take a look at the Immersive Reader tool. Our presentations up top will be in the text area as well. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have the information up top, calculations on down below. We're going to be calculating the bond price. This is something we've seen in prior presentations and prior sections, so if you want to just focus in on the bond price calculation, you could take a look at those sections where we go through it a little bit more slowly and possibly with different methods. Also note, we will be using present value calculations if you would like to see them in more depth and more detail in multiple types of calculations, including tables and formulas. Focusing on a prior section there. The new thing we're tacking on this time is the idea of the bond rating. So we're imagining a situation where the bond rating has a change. That's going to have an impact on the bond price. Then we will recalculate the bond price. So we're going to have the face amount of the bond, 1,000. We're going to say that it was issued at AAA rating, a higher rating, and then there was a rating change to AA3. It was lowered, the rating change, and you can imagine this being done by a rating agency that's trying to help out the market, give a service to the market by measuring the level of risk with relation to the bonds so that the market can then factor in that risk to their market price. We're going to say the maturity is in 10 years, semi-annual on the bonds. So here's our rating table. It goes from AAA to AA3. And so AAA is going to be the highest rating down to AA3, the lowest rating. And of course, these tables, you can imagine them being given by a rating agency. And if they lower the rating of a bond, as we're going to imagine is the case here, then that means there's more risk with relation to the repayment of the bond. And taking that risk into consideration will typically mean that the market wants a higher interest rate or rate of return on the bond to compensate for the higher risk. So in this scenario, we're going to imagine that the bonds were originally issued and they were at the AAA rating. And so they were issued at the market price for the AAA rating, the rating on the bond then being 9%, market rating, market rate, and the bond rate being the same at the point of issuance at the AAA rating of the 9%. Let's imagine that very soon after the initial rating, the initial issuance and the rating of the AAA, it was re-rated to AA3, so it was downgraded to AA3. Then we can think about what would happen to the impact on the price of the bond at that point if it was to be sold at that point in time. Obviously, then the market wants the 11%. So therefore, if the bond was originally issued at the 9% and now it's at the 11%, market wants 11%, and the bond was going to be sold at that point, then we would have to sell it at a discount, right? We'd have to discount the price because the market's going to want a higher return than the return that was on the bond due to the fact that there was a rating change from the point in time of the original issuance and this point in time. So now we'll do our calculation of the bond price. The calculation of the price will be fairly straightforward that we've seen in the past, but just imagining this scenario where this is now 9%, the AAA rating is the amount on the bond price or the bond rating, and the new rating, market rating, is at the 11%. So then we do our typical kind of calculation for the bond price, which is to take the annuity of the bond payments. So we'll take that present value of an annuity, and then we'll take the present value of the end payment at the end of the 1,000. The amount of payments that are going to happen are semi-annual. So the amount of the annuity of the payments would then be 1,000 times the rate on the bond, which is the 9%, because that's what it was issued at, the 0.09. That would be $90, but then divided by 2 because they are semi-annual bonds. That semi-annual is going to complicate things a little bit. So then we're going to go down. Let's imagine we put this into Excel to see the formula in that format. Again, if you look at a prior section, we do these calculations with multiple different formats. So you can look at it there. This formula looks quite long due to the fact, in part, that it is semi-annual payments as opposed to annual payments. But it's not too bad. So negative, we got the rate. The rate, it would be the market rate, which we're saying is now the changed rate to the AA3 rating, which would be the 11%. But that's a yearly rate. Remember, every time you see a percent, it's usually a yearly percent. And if we want to break it down to some other component other than a year period, which we do here, 6-month periods or half-year periods is what we want here, and we're going to divide it then by 2. Then we have comma, number of periods would be 10 if they were years. But once again, we want 6-month period or half-year period. So we're going to take that 10, multiply it, then times 2, comma. And then we have the payment amount, which we just calculated was that, I believe it was the 45, which was be the $1,000 times the amount on the bond. So this being the bond rate, the 9%, but that's a yearly rate. We'd have to take that and divide it by 2 to get that 45. That was the payment. And then we've got the future value. The future value, I'm sorry, that would be the payment. That's all we have. I'm up here. That would be the payment. And that would give us then the $537.77. Then we're going to do the present value of the maturity amount, the face amount at the end. This would be the present value of one formula. Negative present value of the rate. Once again, market rate, 11%. That's for a year though, dividing it by 2 to get the 6-month period rate. Comma, number of periods. Number of periods would be 10 if they were years, but they're semi-annual half years or 6-month periods. So we'll take that multiplied times 2 to get to the 26-month periods, comma, because it's not an annuity, but present value of 1. Future value then is the $1,000. That would give us the $342.73, adding up the $537.77, the $342.73 gives us then the $880.50. That would be the price at this point in time. It being less, of course, than the face amount. We'd have to, if it was sold at this point, it would have to be sold, you would think, for a discount, given the fact that due to the decrease in the rating of the bond, the market has a higher rating now than what the bond was issued for, because the bond was issued at a point in time when it was stronger on the ratings, and therefore the bond rate is lower than the market rate at this point in time, resulting in, once again, the need for a discounted price.